Good morning, everyone. My name's Dan Jones. I'm the Deputy Editor of Investors Chronicle, and welcome to this, the second panel discussion in our Future of Private Investing event. As that name implies, the next couple of days are really all about analysing the big trends and issues of the future, just as any good investor should do. But of course, in investing, your starting point is just as important as where you're going. And this session's topic is the 2022 issue that no one can ignore: inflation. Price growth in the Western world is at its highest level in decades. In the UK, CPI inflation is nearing double digits. In the US, the Fed could raise rates later today by as much as 75 basis points in a bid to get on top of the situation. So all these price rises and tightening of monetary policy have clearly sparked a bit of a regime change in markets, which is a polite way of saying things have been pretty brutal out there this year. The question on everyone's minds, therefore, is how investors can best protect themselves from inflation's impact and the knock-on effects. That's what we'll be discussing today. We do encourage you to get involved in the discussion as well. So please do contribute your questions and queries if you have them. A little bit of housekeeping just before we get going. This session, as with all the sessions, will be available on demand for 30 days, a few hours after it's finished. You can access it through the same link you used to join. There are also useful links, resources, and a feedback link, which can be found on your screen as well. And for this session, we do also have a poll for you to take part in, the results of which will be revealed at the end. You can take part in that by scanning the QR code on your screen, which is a process with which we've all become familiar over the past couple of years, I'm sure. The question itself has to do with how your investing habits have been affected by inflation, and there are a few options to choose from. And we will look at those results, as I say, at the end of this discussion. But on to business. I'm pleased to welcome our panelists today, who are Paul Donovan, Chief Economist at UBS, Natalie Bernand, Head of Investments at Hamish Leng, and Justin Oliver, Deputy CIO at Canaccord Genuity. Welcome, everyone. Great to have you here. Let's kick off with a look back rather than the present or the future. Obviously, this inflationary environment has been with us now for a few months, if not longer. So we do have some evidence of what's been working, what hasn't. That's not to say these same things will work in future, but maybe if we just want to have a bit of a recap, perhaps, of what's been working for investors in their bid to combat inflation in recent months. Justin, why don't we start with you? What have you been looking at? What have you seen in terms of the most effective strategies of recent times?
Yeah, well, of course, we were looking at sort of equity markets. You're looking at equity styles and what worked and what hasn't worked. I think if we're looking back to the first spike in inflation in the US, we're going back to about April last year. If you're looking between April and December, the end of last year, a large growth stocks in the US outperformed, whereas large value kind of underperformed. But again, we've kind of seen a rotation, and that's changed this year. Actually, small growth has obviously consistently underperformed in that sort of period. But I think bear in mind when we're taking a step back and looking, not just at this year, but what's happened again during periods of higher inflation generally. Clearly, it's bad for both stocks and bonds. So again, I think that's what we need to bear in mind in terms of our general investment strategies. We're not in the same investment environment that we were this time last year. That the transitory arguments seem to have been put to bed very, very clearly. It's now more of a permanent situation. So therefore, I think we need to look at strategies and perhaps strategies of what worked and what didn't. Perhaps more during the 1970s rather than just in 2021 or so far in 2022.
Paul, do you agree with that assessment? How do you view it from the sort of economist background?
So I'd agree with Justin that we've got a very different environment now to the inflation that we had last year. We've got two totally different inflation stories. I'm not sure I agree that the inflation story is permanent, and we're certainly not in the 70s in my view. But if we look at what was driving inflation last year, it was very simple. Inflation last year was being driven by a once in 75 year experience in demand for goods. If you look at the demand for durable goods in the United States, the last time we came even close to this was when President Truman ended wartime rationing in 1946. I mean, it's a phenomenal level of demand. Supply responds. We get record supply last year, but it's not enough to meet that demand for goods. And so you get pricing power driving inflation. What's happening this year, though, is very, very different. What we've got this year is actual deflation for a lot of the things that we're experiencing inflation last year. If you look at the US CPI, unreliable statistic though it undoubtedly is, a quarter of US CPI is in disinflation or deflation territory today. And of course, that's creating a very different environment, because as you come under reduced demand and therefore negative pressures on pricing, because last year's pricing was about pricing power and profit margins, that's now being reversed this year. The inflation that we've got this year has been a lot more concentrated, obviously into fuel prices and to a lesser extent into food prices. And so what you've got now is a sort of a narrow focus of inflation on certain items, but then deflation or at least disinflation on a whole host of other items. So it's given you basically two entirely different stories with a break coming in around the turn of the year.
Natalie, what's your take on this kind of shift, and also on how sort of, I suppose, from your perspective, clients have been responding and how you've been communicating with them?
Yes, I mean, I would agree with a lot of what's been said. I think I also agree that it's not the 1970s, but certainly for clients, it's becoming a real worry. You know, this time last year, we were talking about inflation in a transitory way. For us, we're always trying to outperform inflation for clients. We're not really worried about what the FTSE or the MSCI world is doing. Our clients are thinking about what their costs are going to be and if they're going to have enough money going forward. So it is, I think we are in a really tricky place. I think it's very difficult to know what's going to happen next though, because as Paul says, food and fuel prices have gone up, but how long will that last? And I have a lot of friends running different businesses, sort of small businesses or working medium-sized businesses. They're seeing inflation pressures throughout everything they do. And so it's just trying to readjust or think about how, portfolios can adjust to that if it's going to last longer than expected.
Justin, if we return to you, we sort of look at what you're doing this year, what your firm is doing. How has that shifted specifically in terms of, if at all, in terms of the types of instruments, the types of assets you're looking at to provide a durable return in this environment?
Sure. I think I'll just certainly first off clarify my comments. I don't think it is the 1970s, but clearly I think we need to be looking back, because that was obviously the last period where inflation was an issue in terms of financial markets. So we're trying to use that as a guide for looking forward and in terms of setting strategy. And I think if you're looking there, actually some of those lessons you can apply to to the current situation. So the assets that you wanted to avoid during those inflationary periods, and certainly at the end of the 70s, were the kind of consumer durable stocks, and we'll see US Treasuries and investment grade bonds, and again we're kind of seeing that. The assets that you wanted to hold are again kind of similar to what we're seeing at the moment, which is basically commodities. Historically, energy commodities tend to deliver all of their returns during those inflationary periods. Gold and precious metals also performed well in real terms, but actually all commodities protected. Energy stocks were also the place to be. I think it's also notable actually, and some work done by some Man Group in terms of this, and ways that you can potentially benefit from those inflationary periods. Trend following, I think, is a factor that they've also have identified as potentially being an area worthwhile. And actually, again, areas that we're looking at, large companies and quality stocks, with consistent profits, strong balance sheets, all tend to do well during those inflationary periods. Small caps maybe not so well. So again, I don't think it's the 1970s, but again, I think we're using it as a guide to what we are, because I think obviously inflation is an issue, and it might not drop off as quickly as perhaps some hope.
Paul, just to return to your point about the drivers really shifting in your view, how does that feed through to what you expect from asset prices over the next year, insofar as anyone can expect or can anticipate these things? Commodities on one hand obviously roaring, but if we have disinflationary pressures elsewhere, how does that affect what investors should be thinking about?
Well, I think we've got this sort of quite peculiar situation that obviously a lot of the demand for durable goods, to Justin's earlier point, that we saw last year, that was fading anyway. And then you've got a second impulse to cause that demand to fade, which is that you're getting demand destruction. If I'm spending more to put diesel into my car, I've got less money to spend on consumer electronics, for example. And that demand destruction is very clear. I mean, we're certainly seeing that come through on both sides of the Atlantic. It's being reported in credit card data. It's being reported in the retail sales numbers. So we've got that shift in demand, and that obviously is going to affect certain sectors of the market, the equity market in particular, and I think cause underperformance there. If we then look at, say, okay, well, in that case, let's look at the commodities. They've got the pricing power. There's relatively inelastic demand. That's all true. But of course, what I think has shifted, partly as a result of the pandemic, partly as a result of the changing nature of politics, is political risk. We're in a world of single issue politics. People don't join political parties anymore. They click like on a Facebook group. But the problem with that from an investor perspective is that if a sector or an issue becomes a TikTok meme, suddenly politicians are going to start paying attention to it. And that's why we're starting to see things like windfall profit taxes, increased regulation, accusations of collusion in the oil industry. This sort of thing is becoming a lot more significant. So we've got a sector of the market where I think the demand story is clearly looking softer, but then we've got another sector of the market where you might think, well, actually, here's where we've got the pricing power, but that also enhances the political risk, and that, I think, creates the challenge. So you end up, I think, yes, looking for value stocks in this sort of environment. That seems to be a fairly reasonable conclusion, but there's a lot of noise that's going on around this.
Natalie, if we consider, again, how this all translates into returns overall, the overall return picture. Now, it seems to me that, professional investors have been saying for many years that, long-term returns are going to be lower than the past. Until this year, maybe last year, that hasn't been the case. But how are clients, therefore, this is investors of all kinds, private investors, advised investors have had this kind of drilled into them. Do you feel people are ready to appreciate this message, as tough as it is, that returns might be lower, or do you think that's not the case and you can still eke out a pretty decent return?
I mean, I think for our clients, they definitely get it. We have been talking to them for the last few years about the sort of what the after effects of QE was going to be. And we put a sort of chunk for all of our clients into quite defensive managers who've had those messages and who have been worried about inflation for longer than maybe the market has been worrying about inflation. So I think that our clients are pretty sensible on that note. Most investors who have been invested have done very well over the last decade. And I think when they look back at previous years, that they're aware of that. The goal really, I think, for most clients now is capital preservation, going into this sort of, or being in the sort of market we are and looking at the risk going forward. I think that is where clients really are quite focused. And, to that note, we think about sort of buckets in terms of when clients are going to need the money. So clearly cash is not great in an inflationary environment, but it does allow you to be nimble and quite defensive, especially if we don't really know where we're going with inflation or potential recession. And then we hold quite defensive managers for then sort of the next kind of 2 to 7 years. And then, I do think equities are still appropriate. It's just in what percentage. And again, I think our managers are generally looking at high quality stocks that have pricing power, moats, inelastic demand. I think global equity income funds can perhaps be quite helpful in this sort of time period as well, or going forward. Certainly, if we look at the 1940s or the 1970s, dividends are, a substantial part of total return. So those are some of the different things that we're thinking about.
Justin, maybe we just hark back to what Paul was saying about, value being a good tactic in the current market. I mean, is that something you agree with? How do you see that kind of value versus growth split right now? Particularly perhaps if we are getting into a situation where people are starting to worry, obviously, about the monetary policy tightening tipping us into a slowdown, if not a recession. How do those two kind of dominant styles interact in that scenario?
Yeah, I think certainly in terms of the options available, value might be the best of potentially a bad set of options. But again, going back to history, if we're going back to the end of the 70s, value certainly outperformed growth, and certainly outperforms inflation during this time. If you're looking back again in longer term history, actually what's outperformed US inflation in every decade going back to the 1930s is small cap value. Small growth has had quite a good also track record, albeit underperformed in the 70s and also the 2000s. Albeit again, I sometimes think it might be a bit too simplistic to look at just value versus growth. Just to build on some of the previous comments, maybe it's more about the characteristics that certain companies have. So whether it's that pricing power, which might not be the likes of Netflix, etc., in this sort of environment, where they've already sort of sunk, where companies maybe have sunk a lot of cost already into their assets, so they haven't got those that extra expense. And also, generally in some kind of low duration assets. So, getting back to companies which are making profits now, not just expected to make profits in 5, 10, 15 years. So I think again there's some interesting work done by Goldman Sachs on that, which shows basically since the 1990s, non-capital intensive companies have significantly outperformed those within the capital intensive side. Maybe again what we're seeing now is a change in the investment environment, and maybe that trend will reverse. I think in general terms, if we're looking at let's say banks versus tech, probably prefer banks in this sort of environment.
Yeah, I think that's definitely will chime with our readers, our audience, in terms of the stock picking opportunities out there as well in some of these areas, and the need to look for those characteristics. We've had a couple of questions in. First one I'll put to you, Paul, just China and its impact perhaps on the inflationary debates, if at all. We've had in recent years when China has turned on the taps, it's helped stave off periods of disinflation, deflation. Right now China's economy obviously is struggling and closed in large parts. It has been for a few months. How do you see what's going on in China, which can still be somewhat opaque to the rest of us over here? How do you see that impacting inflation globally?
Well, China, of course, has been very interesting. There's this sort of myth that globalization was a huge disinflation force. And in actual fact, globalization over the last 20, 30 years probably pushed up inflation about 0.1% a year globally, because what it did was lower manufactured goods prices, which is what China is producing, but raise commodity prices, which is what China consumes very inefficiently. What we're seeing now is China's export sector has actually been very resilient throughout the period of the COVID restrictions. We had nothing like the devastation that we saw in 2020, for example. The production numbers again today coming in very strong. So China is continuing to supply goods. And when we look at goods prices, therefore, I think China will actually be a force for disinflation, because what's happening is we've got record global supply of goods today. We've never made so many goods as we're making at the moment. But the demand for goods is starting to slow down because of exhaustion, because of demand destruction and so on. So that's exerting a disinflation force, but in one sector, in the goods sector. My concern is that as we move towards lifting the restrictions in China, the government's response to stimulating domestic demand is let's build more roads, let's build more housing. The infrastructure projects are being rolled out, and perhaps I'm scarred by my earlier experiences as a Japanese economist in the 1990s, but frankly, these infrastructure projects tend to bid up the demand for commodities, but they don't necessarily do that much to stimulate the domestic economy. The result of that, I think, is that you could again see what we've had basically over the course of the last 20, 30 years, where China is an inflationary force in commodities, in selected commodities in this instance, but a disinflation force in terms of manufactured product. And I think that pattern is probably going to continue over the latter part of this year.
I've got a couple of other queries relating to China emerging markets, but we'll address the other audience question first. In a broad term, perhaps, Natalie, a lot of people, certainly our audience and demographically everywhere are going to be at retirement or approaching retirement with their investment strategies, and suddenly confronted with this big shift in markets and these big drops. What should they be thinking about? Obviously, every individual is different; their circumstances are different, but how should they be thinking about making sure that pot is there and is what they expect, insofar as that's possible in 12, 24 months time, given what we're seeing going on at the moment?
Yeah, I mean, I guess the question is how they're invested at the moment. Clearly, it would have been great to go into this with a sort of sizable chunk in defensive type managers. I think clearly there are a lot of investors who are probably weighted more heavily to growth than they would like to be at this stage, and that is a difficult question because we've clearly seen the market come down this year. How much of another leg down are we going to have? I think until we get some real certainty in terms of how fast the Fed is going to move, it's going to be very difficult to know the answer to that question. What we've really seen is, especially with our defensive managers, in the past, anytime there's a market downturn, they have used that downturn to really up their equity weighting. So if you look at 2008, for example, we saw some defensive managers go from sort of 30% to 60% in equities because they were taking advantage of opportunities. We saw the same thing when the lockdown happened in March 2020, where managers thought this is a great time to buy. What we're not seeing it happen this time. Basically, our defensive managers are staying in that kind of 30-35% equity weighting, and they're not upping it. They are worried that things will go down again. So it's quite difficult, I think, for individual investors, but it depends on what they're invested in. I mean, are they invested in the kind of really growth sort of stocks, or are they invested in more in sort of quality growth stocks, which I think over time, I mean, Microsoft is not going to go out of business if we have a recessionary environment or if we have stagflation. So it's a difficult question, but it really depends on an individual basis with a client what they have right now.
Sure, thank you. We've had another question in, and it makes a fair point in that so far we've largely been focused on equity and bonds, but of course a lot of investors in recent years have replaced a lot of that bond content in particular with alternatives, the likes of infrastructure, property, and so on. Justin, how do you see those kind of asset classes functioning in this kind of environment? Obviously, again, infrastructure has done really well for several years now. It's trading, if you look at the investment trusts, on quite high premiums still. How do you view those alternative assets and their role?
Yeah, I mean, you summed it out quite well. Again, we've liked infrastructure, for a while, not least because a lot of the revenue streams are linked to inflation. So in the sort of environment that we're at the moment, that's good news. And ultimately, as we know, sort of inflation or stagflation isn't going to be good for traditional assets. But you've got to again be slightly wary of the price you're being asked to pay for these assets, and actually, as importantly, the price that the underlying managers are having to pay to secure access to some of these some of these revenue streams moving forward. So yes, I think in the sort of environment that we've got at the moment, I certainly would suggest avoiding bonds and avoiding those more nominal assets. A mixture of kind of real assets, as Natalie said, maybe investing internationally, global equity is the way to go. Counterbalance with some exposure to infrastructure related investments, and obviously perhaps also having maybe having a look at different currencies a little bit more in this this sort of environment. Again, if we're expecting commodities to remain quite well bid, or if we're expecting maybe stagflation to take hold, maybe sort of currencies like the Australian and Canadian dollars work quite well. Swiss franc again, which is very much seen as a safe haven. Those are sort of areas I think perhaps we need to look at. Again, the investment strategies which have worked in the past may not be where you want to be invested moving forward.
Natalie, when you think of sort of the alternatives bucket, is that a fair reflection of your views as well? Renewables,
absolutely,
perhaps, on top.
completely agree on infrastructure. I think there's also, there are macro managers who can take advantage of dislocations in rates and FX. I think currency is something we're all thinking about quite a lot. We had a client in the other day, and they're planning on really traveling for the next 2 years, and where sterling is does matter. Gold can be a shelter, property can provide a protection, but of course valuations matter. I think that there's a lot of different strategies that can be useful, but they haven't necessarily been tested in the sort of situation we're going into.
Let's shift back to emerging markets for a moment. Paul, obviously you were touching on China there. And we've also spoken, as one would expect, about the experience of the 1970s in looking at what we can do to protect against inflation. Obviously, emerging markets and emerging market investors have dealt with high levels of inflation, much more recently than that. Are there any lessons there, or different lessons that can be learned from those experiences for investors now seeing it in their home markets for the first time in a long time?
I think it's quite problematic because, emerging markets are closer to the 1970s experience in many ways, in that emerging markets tend to be far, far more focused on food and fuel. It's a far higher part of their basket of goods. And you get price controls. Remember, in the United States, prices weren't set by the market in the 1970s. Prices were set by President Nixon because there was total wage and price control in the early 1970s. So you've got a very, very different sort of inflation experience where, you get shortages because of government interference in the market, where commodity prices are far more important and labor prices are far less. One of the challenges that we've got now, and actually where I think the focus is starting to shift in developed markets, is we're hearing more and more from companies, not so much about, how much pricing power do we have, but how much is demand going to weaken as the higher cost of fuel starts to erode consumer spending power. So we're actually getting sort of a demand deflation concern emerging in developed economies. And that's not something you tend to experience in an emerging market where you're talking essentially about food and fuel as being the dominant driver of inflation. So I think we've got to be careful about learning the lessons because the concerns are very, very different. And I think we also need to reflect on the fact that because inflation is more complex in a developed economy, one of the real challenges is that the headline inflation number is probably not relevant to the actual experience of a large number of investors. So, I manage money for my college, for example. We really don't care about the cost of petrol because it's not a part of our direct inflation experience. We certainly don't care about the cost of used cars because it's not a part of our direct inflation experience. If you're managing a college endowment, you care about crumbling buildings and crumbling academics. That's your cost base. So there's a real issue here, I think, that because inflation is a more complex subject matter in developed economies, it requires a lot more complexity of analysis on the part of investors. Somebody who is retiring has a very different inflation experience from somebody who's in their mid-20s, for example.
Yeah, that definitely makes sense. And again, I think it's reflected in the kind of concerns we're seeing from readers and from investors in general. If we think, I touched on the beginning about the US, and we've got the Fed's decision today, and there's obviously going to be a hike of some form, maybe a pretty significant hike. Equally, there have been some noises until maybe the last inflation report that, Paul, as you've implied as well, that there are various aspects of that basket which are starting to turn downwards now. So my question really is, if we get a scenario where US inflation starts to reverse and maybe that shifts markets' minds again, could we, as a UK audience, as most of the audience will be here, could they find themselves in a scenario where markets are starting to react? The US is always the tail that wags the dog, starting to react to a US environment where inflation is dipping, whereas over here we're still seeing quite elevated levels of inflation. Could there be that kind of disconnect, is what I'm asking, between, again, that kind of personal experience and what markets are starting to do? Is that something people should watch out for? Justin, I don't know if you have any thoughts on this theory.
Yeah, many thoughts. Well, obviously, as you pointed out, the US is the most important economy. It's the bellwether for global financial markets. US Treasuries really kind of again set the base for all other assets. So clearly, what's going on in terms of US inflation is really important. If we're looking at differences between the US and UK inflation rates, again, from our perspective, a lot of the increase that we've seen are being driven by the similar sort of factors. So whether it's constrained supply chains, the oil and energy and food prices, etc. There's a few other things going in the UK which is kind of exacerbating that. In fact, I think your own FT analysis showed that obviously sort of revealed the UK is probably set for the highest inflation in the G7 from now until 2024, because again it's kind of in that worst place scenario of being having the worst aspects of mainland Europe, and so in terms of surging energy prices, and also those in North America, which is kind of the rises in other goods and services. So in a way, I'd be surprised if the inflation rates diverge that significantly. But above all, what matters, I think, for financial markets is what goes on in the US, and particularly if you kind of got a global asset allocation perspective. Again, we're not constrained to just be investing in the UK, for example. We can look to other areas, and potentially other areas where maybe inflation is less of a problem at the moment, and maybe China is one of those economies to look at from an investment point of view.
Paul, just going back to you briefly, if we, again, to return to your comments at the beginning, looking at, what's happening this year, oil, food, energy prices in general, food prices elevated clearly at the moment, rising quite significantly. Do you have what's your view on, how long we can expect this to last? Obviously, as I think Justin said at the beginning, the transitory argument has been put to bed, but I'm sure a lot of investors are wondering, when this kind of scenario might change. When we look at those prices, when we look at supply chains, obviously as well, we've been waiting a long time for signs of improvement there. Are there any signs of, light at the end of the tunnel on these issues?
Well, I mean, I would argue the transitory argument was right. The transitory inflation proved to be transitory. And that's where, as the demand has weakened, you're seeing the disinflation and the deflation forces. It was just unfortunate that the war in Ukraine has obviously then produced a separate inflation surge. I think what gives me comfort about the longer term inflation outlook is the fact that we have got zero evidence of a wage cost price spiral. I mean, this is one of the remarkable things, that wages are just not behind this inflation story at all. And that's very, very unusual, because normally wage costs are 60 to 70% of the inflation number, and they're about 10% of the inflation number today. So we're in a very, very different situation there. And it leaves us then sort of somewhat of a victim of the movements in commodity prices, because that is where most of the inflation impulse comes through. I mean, a quarter of UK inflation is electricity and gas prices. I mean, that's an astonishingly high chunk. So I think we've got to look to that and see where that comes through. And what we do need to remind ourselves, of course, is inflation is the change in prices, not the price level itself. So we may well continue to suffer with high price levels, but I think the change in commodity prices is going to fade as an impulse over the course of the next 12 months.
Do you think that will be the kind of, perhaps a trigger for a bit of a market shift? Right now, again, we're seeing pretty big drops every week on it feels like on major indices. What are investors looking for really for that to change? Is it a peak in inflation? Is it a sign that the tightening cycle is over, or that we've avoided recession? How do you see that, Paul?
For me, I think it's got to come from the central banks. There is greater clarity about where central banks are going to be taking policy. At the moment, there's too much uncertainty about central banks. Personally, I think one of the reasons why 75 basis points from the Fed, which they may well do, is a policy error, is that if they do 75 today, the markets are never going to believe Fed guidance again. Because why would you? Because they've been guiding for 50 right up until the blackout period this time. They do 75, you add that uncertainty. So I think minimizing the uncertainty is going to be one of the key things to try and do here. And when we get greater certainty about a more stable approach from central banks, that probably for me is going to be a turning point for markets and investors.
Great. Thank you very much. Thank you to all the panelists. We are now running out of time, so I really appreciate your thoughts. It's been a great discussion. Thank you to you for tuning in. There should hopefully just be time to have a look at some poll results. which could be appearing on screen. How have your investing habits been affected by inflation? Obviously, multiple choice, and there may be some multiple answers, but clearly the two winners there are increasing investment opportunities to buy the dip effectively, and looking for higher risk but also higher return investments. So clearly, I think we've got some optimistic choices there and some bold choices, but hopefully those that should serve investors well in the long term. Thank you again for listening in. Do please join me for our next session in just a few minutes' time. That's going to be on US equities in particular, so we can continue some of these discussions. We'll see you then. Thank you and goodbye.